Well, ladies and gentlemen, welcome back to Boss Economics World, the only show that takes the dismal science of economics and turns it into a full-blown tragicomedy. I'm your host, the guy who's here to break down the Fed, fraud, and the fiery political dumpster fire that is 2025, all while sipping on my overpriced oat milk latte because, hey, inflation's still a thing, right? Today, we've got a story so juicy, it's practically dripping with economic hypocrisy, political meddling, and enough mortgage shenanigans to make even the most stoic central banker blush. So, buckle up, folks, whether you're a finance bro, a TikTok investor, or just someone trying to figure out why your rent's higher than Elon Musk's ego, this one's for you. First up, let's talk about the Federal Reserve, that mystical institution that's supposed to be independent, impartial, and totally above the political fray? Yeah, well, not in 2025, baby. We've got Trump and his posse, led by none other than real estate mogul and self-proclaimed Fed watchdog, Bill Pulte, trying to turn the Fed into their personal piggy bank. Their mission? Force Jerome Powell to resign before his term ends in May 2025 and strong-arm the central bank into slashing interest rates faster than you can say quantitative easing. But wait, there's more. Enter Lisa Cook, Fed governor extraordinaire, who's now caught up in a mortgage scandal so convoluted, it sounds like a rejected script for The Wolf of Wall Street 2, subprime boogaloo. Now, let's break this down, shall we? Because this story isn't just about one Fed governor's questionable real estate decisions, it's a masterclass in the economic issues plaguing our system, from political interference in monetary policy to the Wild West of mortgage lending. And trust me, folks, this is gonna get spicier than a GameStop stock rally in 2021. So, grab your popcorn or your overleveraged crypto portfolio and let's dive in. Let's start with the big picture, shall we? The Federal Reserve is supposed to be independent. That means it's not supposed to bend the knee to whichever political party is screaming the loudest on Twitter, X again. But here we are in 2025, and Trump and his allies are treating the Fed like it's their personal ATM. They want lower interest rates, and they want them yesterday. Why? Because lower rates juice the economy, make stocks go BRR, and most importantly, make the incumbent administration look good. But here's the kicker, folks, meddling with the Fed's independence is like letting a toddler drive a Ferrari. Sure, it might be fun for a hot second, but it's gonna end in a fiery crash. Now, let's talk data, because I know you finance nerds out there love a good stat. According to a 2023 study by the International Monetary Fund, countries with less central bank independence, like, say, Turkey, where President Erdogan famously pressured the central bank to slash rates in the face of 80% inflation, saw inflation rates double those of countries with independent central banks. And guess what? The US isn't immune. Just look at the 1970s, when political pressure on the Fed led to stagflation, a toxic cocktail of high inflation and high unemployment. Back then, inflation hit 14.8% in 1980, and unemployment peaked at 10.8% in 1982. Do we really want to go back to the days of disco and despair? I think not. And let's not forget Trump's latest move, nominating Stephen Miron, one of his economic aides, to fill the vacancy left by Fed Governor Adriana Kugler's surprise resignation. Now, I'm not saying Miron's unqualified, but let's just say his resume screams loyalty to Trump more than loyalty to economic stability. This is how you erode trust in institutions, folks. And trust me, when markets lose faith in the Fed, it's not pretty. Just look at the 2022 bond market meltdown, when the Fed's rate hikes caught investors off guard. Yields on 10-year treasuries spiked to 4.3%, and the S&P 500 tanked 19%. Now imagine that, but with a side of political chaos. Yikes. Now, let's zoom in on Lisa Cook, our Fed governor caught in a mortgage scandal that's so wild, it could star in its own Netflix docuseries. Here's the deal, Cook allegedly took out two mortgages, one in Ann Arbor, Michigan, for $203,000, and another in Georgia for $540,000, just 2 weeks apart in 2021. Both mortgages had clauses requiring her to use the properties as her primary residence for at least a year. But wait, plot twist. Bill Pulte, our self-appointed Sherlock Holmes of real estate, claims Cook listed the Georgia property for rent shortly after buying it, suggesting it was never meant to be her primary residence. Oh, and did I mention she might have gotten favorable loan terms by misrepresenting her intentions? Yeah, this is the kind of drama that makes succession look tame. Now, before we all grab our pitchforks, let's be fair, Cook hasn't been charged with anything, and the Justice Department and Fed are staying mum. But here's the bigger issue, folks, this story shines a spotlight on the gaping loopholes in our mortgage system. See, when you apply for a mortgage, lenders give you better terms, like lower interest rates, if you say the property will be your primary residence. Why? Because owner-occupied homes are less risky than investment properties. According to a 2024 report by the Urban Institute, default rates on investment properties are 2.5 times higher than on primary residences. So, if Cook or anyone else games the system by claiming a property is their primary residence when it's really an investment, they're not just breaking the rules, they're potentially screwing over honest borrowers who play by them. And let's talk scale, because this isn't just about one Fed governor, it's about a systemic problem. A 2023 investigation by ProPublica found that mortgage fraud, including occupancy fraud, has surged since the pandemic, with an estimated $6.2 billion in fraudulent loans issued in 2022 alone. Why? Because low interest rates and a red-hot housing market created a feeding frenzy, and lenders, desperate to cash in, often turned a blind eye to red flags. Sound familiar? It should, because it's eerily reminiscent of the subprime mortgage crisis of 2008, when lax lending standards led to a global financial meltdown. Back then, defaults on subprime mortgages triggered a domino effect, wiping out $10 trillion in U.S. household wealth. Are we really gonna let history repeat itself? I mean, come on, people. Now, let's tie this all together, because the Cook scandal and Trump's Fed meddling aren't just isolated incidents, they're symptoms of a bigger disease, a credibility crisis at the Federal Reserve. See, the Fed's power rests on trust. Trust that it'll keep inflation in check, trust that it'll act in the best interest of the economy, and trust that it's above political nonsense. But when you've got a Fed governor embroiled in a mortgage scandal and a former president trying to turn the central bank into his personal cheerleading squad, that trust starts to erode faster than a sandcastle at high tide. And here's why that matters, folks: when trust in the Fed crumbles, markets freak out. Just look at the data. A 2024 study by the Bank for International Settlements found that central banks with low credibility see 30% more volatility in bond yields and 25% more currency depreciation during crises. Translation? Higher borrowing costs, weaker dollars, and a whole lot of pain for everyday Americans. And let's not forget inflation, which, spoiler alert, is still a problem in 2025. According to the latest Bureau of Labor Statistics data, core inflation is hovering at 3.8%, well above the Fed's 2% target. If markets start doubting the Fed's ability to tame inflation, we could see a repeat of 2022, when inflation expectations spiked and forced the Fed into a brutal rate hiking cycle that tanked the housing market and crushed small businesses. And here's the kicker: this credibility crisis couldn't come at a worse time. With global tensions rising, think US-China trade wars 2.0 and Europe's energy crisis, and a US debt ceiling showdown looming in late 2025, the Fed needs to be a rock of stability, not a political punching bag. But hey, maybe I'm just being dramatic. Maybe Trump's meddling in Cook's mortgage mess will all blow over, and we'll be sipping piña coladas on a beach of economic prosperity. Or maybe, just maybe, we're on the brink of an economic clown show that'll make the 2008 crisis look like a warm-up act. So, what's the takeaway, folks? First, we need to protect the Fed's independence like it's the last slice of pizza at a frat party. That means telling politicians on both sides of the aisle to keep their grubby hands off monetary policy. Second, we need to crack down on mortgage fraud, because if we don't, we're just begging for another housing bubble to burst. And third, the Fed needs to clean house. If there's even a whiff of impropriety, it's got to be addressed transparently and swiftly, because trust is the Fed's most valuable asset, and once it's gone, it's gone. Now, I know what you're thinking: boss, this all sounds like a hot mess, but what can I do about it? Well, for starters, stay informed. Follow the data, not the drama. And if you're a finance pro, hold your industry to a higher standard, because if we don't, we're all going to be paying the price. Until next time, this is Boss Economics World, reminding you that the economy's a circus, but you don't have to be a clown. Peace out.